Hello, everyone. I just want to give a brief little commentary on momentum. Now, momentum is important. Momentum is not volatility. Momentum is how far something has moved between time period A and time period B. Now, at Stock Market Jobber, we don't waste our time focusing on things that are irrelevant, or comical, or scientific, or I should say science fiction. We focus on what are the important price levels, what is the trend, what is momentum. That right there, understanding that in investment psychology is the secret to being a good trader, successful and profitable trader. So momentum is a measure of how far a stock has moved in a particular period of time. So like in a week, 2 weeks, a month, or different ways to measure it. It's not the same as volatility. So for the vast majority of the time, a stock or a security or a ETF, I'm just going to go with stocks as my default, but whatever you're trading, a crypto, commodities, bonds, the vast majority of the time they're within their typical or normal trading ranges. That's why they're called typical or normal. Now, if something gets really aggressively bought, if investors get overly exuberant or enthusiastic and they buy it aggressively, it could get above what this range is. We call this overbought. On the other side, if investors get really bearish or really kind of freaked out and they knock the stock down or the stock and it gets below this normal or typical trading range, we call that oversold. So this is important because when markets are overbought or oversold, there's a good chance that they reverse. A lot of trading systems or trading strategies on Wall Street are based on this concept of reversion to the mean. So I'm going to talk a little bit about it. And, it's like we're not reinventing the wheel here or doing an encyclopedia. I think that within, 5 or 6 minutes, I can hit on some of the important points that are going to help you improve your trading. Now, there are a lot of ways to measure momentum. They can be very simple or very complicated. Whatever software package you're using for your trading, go and look at the indicators, the technical indicators. There could be, I don't know, 100, 200. Probably 80% of those are just different ways of measuring momentum. So there are different ways of measuring the same thing. A lot of times I see newer traders or traders that want my input or they're trying to learn. They'll send me their charts and they have like 5 or 6 momentum indicators on their chart. And it just doesn't make sense because these are different ways of measuring the same thing. Now you're probably going to say, like, well, gee, Mark, which one is the best? The answer is it all depends on what fits your style or what fits your eye. Well, I don't want to say style, but what fits your eye. Over the last 2.5 decades, I've basically just stuck with Bollinger Bands and the relative strength indicator. But that doesn't mean that they're the best. I would encourage you to go through them all. Well, not all of them because there's like almost 100, but or even more. But just pick 2 or 3 that kind of fits your eye or fits your structure, or and then just get really good at them and really know the nuances. There's no reason to have 10 different momentum indicators or oscillators on your chart. But if you pick 2 or 3 and you really get to understand them and know the ins and outs, then that's where you're going to really get some success. Because nothing is perfect. There's no way you can say, oh, this one indicator is the perfect one. If it does this, well, then it's time to buy. If it does this, it's time to sell. It's kind of this, like, I guess, mosaic of different things you have to look at. So remember, oversold markets tend to rebound or rally. When a market is oversold, meaning it's below its typical or normal trading range, momentum traders go in there because they think, all right, well, this thing is oversold. A lot of times, in fact, most of the time, things tend to revert to the average. So if we're way below the average, there's a good chance it's going to revert. And sometimes they're coming into it in and of itself could move the market higher. Their buying could move the market higher. If something is overbought, it's the opposite. The market is kind of running out of buyers, and momentum traders are going to come in because they're going to be expecting a reversion to the mean. Again, a lot of trading systems on Wall Street are based on this concept of reversion to the mean. Now, what I want to show here is Some popular momentum indicators. I like to use relative strength index, and I like to use Bollinger Bands. Notice how this is Wall Street back in probably the 1600s. Notice the wall. This is why it was called Wall Street, actually. Up here is where Trinity Church is now. Notice the turrets, or whatever they would call them. I don't even know what you'd call them. The bastions? But anyway, one of the things about stockmarketjobber.com is that we love history. And understanding Wall Street history helps you be a better trader. Because what you need to understand is this. Trading is based on human psychology. It's not based on some super secret system. It's not based on what some quote unquote pundit on CNBC or Fox Business News is saying. It's based on, if you're doing it right, it's based on human psychology. Now, the names have changed, the people have changed, but human psychology doesn't change. If you were to get charts or writings or whatever from back in these days, the great traders would be saying the same things that they say now. They would be saying, cut your losses short, let your profits run. Human nature has not changed. But anyway, so I like to use the relative strength index. I like Bollinger Bands. I like to use the DeMark indicator. I don't really use commodity channel index, but I know people that do. I don't use rate of change, but I know people that do. So these are, just because I use them doesn't mean they're not valid. What I want to encourage you to do is go through these indicators, throw a bunch on your chart, and just see which one kind of fits your eye. Everyone is different. What works for one person doesn't work for another, right? Say you're a guitar player. Well, you pick up a guitar, okay? Are you a blues guitarist? Are you a classical guitarist? Are you a rock and roll guitarist? There's no right way to do it. You just have to do what fits your personality. And the trouble, or one of the problems with a lot of this stuff is people that come into this and they're just starting to learn, they're looking for this, like someone to teach them the secret method or, whatever. And that's just not how it works. Like if, if you go to study karate with a good sensei, right, he's going to teach you the basics and the fundamentals, but you're going to have to eventually evolve into your own strategy or your own personality. Like I said, with guitar playing, right? What fits you? Now, I like relative strength index. I like Bollinger Bands. I think it might be a good place to start. But, it's not the be all and end all. Don't be afraid to explore some of the other things and see if they fit. Now, check this out. So here's Tesla, and I just put 3 of the common indicators on here. So here is relative strength index. This is the one at the top here. The middle one is what we call moving average convergence divergence. And the bottom one is stochastics. Now, remember, again, these are different ways of measuring the same thing. So you can see they all look kind of similar in a lot of ways, right? We start to go down there, we start to go down there, we start to go down there. We level off right there when we get oversold, right? So if we're below this red line, we're oversold. If we get this crossover, we're oversold. If we go down here, we're oversold. So you can see it's just different ways of measuring the same thing. So my advice is pick 2 or 3 of them, get really comfortable with them. You're going to learn what they're telling you. You're going to learn the nuances. I'll give you an example of a nuance, right? You're like, what the hell is a nuance? Well, the relative strength index measures, see that 14 there? It measures 14 time periods. So in this situation, we're using days. Every one of these candles is a day. Now, say something gets really, really crushed and goes down like 30%, and then it comes all the way back, and at point B, it's at the same level as it was where we started at time period A, time period B, it's at the same level it was in time period A. Well, the indicator is going to show you that momentum is neutral because it stopped at the same place it started at. It doesn't account for the big move it made. Momentum is just a measurement of how much something has moved from time period A to time period B. If it ends up at time period B at the same place it was at time period A, it's going to be considered, or it's going to show neutral. But if you understand that, and if you understand that this is one of the nuances of really learning how to use the RSI indicator, you're going to be able to say to yourself, well, you know what? The indicator is telling me it's neutral, But because I know this indicator so well, I realize that there's a new, I don't want to say a flaw, but there's a nuance in this. It got crushed for a week and now it's ripping back higher. So maybe it's overbought, even though that doesn't show up on the indicator, right? Pick two or three, get really comfortable with them. Could take you a couple months, but it'll be worth it in the long run. All right, everybody, thank you so much for being a part of stockmarketjobber.com, and I hope to see you soon.